Hello, everyone, and welcome to tonight's presentation. My name is Derek Eichenwald. I have the distinct pleasure to serve as Triumph Capital Management CEO and Senior Investment Executive. I'm confident that you will benefit from tonight's presentation. We'll be covering a lot of information and to help you in your note-taking endeavors, to help you with some of this material because it is vast. I provided you all with some handouts. You have tonight's presentation being provided to you in PowerPoint format as well as PDF format. And there is also our tax tables for 2023. If you would like to take a moment, if you notice your handouts, you can download those to your PC. Those are being made available to you throughout the presentation. In addition, tomorrow, you will receive a recording of this presentation via email. So anyways, let's get into it. Before we begin, I will start with just some important disclosures. Triumph Capital Management is an independent firm. We are a registered investment advisory firm with the Securities and Exchange Commission. We are located here in Denver, Colorado, but have offices up and down the Front Range, as well as in California. Sometimes we do this presentation live, so as a housekeeping item, I like to tell folks, hey, let's turn off our cell phones, so on and so forth. A little bit about myself, the speaker. I already introduced myself, Derek Eichenwald. If you hear an accent as I go through tonight's presentation, I'm originally from Massachusetts, but I've been out in Colorado for the better part of 20 years. So before we dive in to tonight's talk, let's go a little bit back in history. The first income tax was proposed in 1814 to help fund the War of 1812. But the tax never happened because the Treaty of Ghent ended hostilities in 1815, which meant the U.S. no longer needed the extra revenue that they were trying to generate from taxes. So the first tax that ever came into place was imposed by President Lincoln. It was the Tax Act of 1862. And the way that that works is there was a 3% tax on income above $600 and a 5% tax on income above $10,000. Records show that very few Americans actually filed a tax return or even paid these taxes. You know, it kind of never really happened, right? Well, anyways, 1872 came along, and in 1872, they repealed the Tax Act of 1862, 10 years later, and there was no taxes in the United States of America. In fact, what provided the nation's revenue was tariffs, and these tariffs stayed in place for decades. You didn't even have to file a tax return. Well, in 1913, the 16th Amendment was ratified, and it gave Congress the authority to tax American citizens' incomes. And that's what they did. So along with tariffs and everything else, taxes came into play. So during 2022, the fiscal year, how much money do you think the U.S. government collected in individual taxes? Just ask yourself the question. If we were live this evening, I would take some guesses. But if you had to think, okay, how much money did the United States of America bring in just from individual income taxes, not from sales tax, not from this, not from that, just from the tax returns that we're all now filling out? So everyone has a number in their head. Let me tell you what the number was. $2.6 trillion is what was collected in 2022 from individual income taxes. Now, remember, you are paying taxes and a whole bunch of other things. You go out to eat tonight, you get your bill, taxes at the end of it, right? Also, the federal government raises money not just from collecting individual taxes, but from a whole bunch of other stuff, such as tariffs, such as admission of state and different types of parks around the country, so on and so forth. So now I ask you, how much money do you think the federal government brought in revenue in 2022? Maybe answer that question to yourself. And the amount of money that the federal government brought in 2022 was $4.9 trillion. Okay, $4.9 trillion. And it's an awful lot of money. Okay, next. I want to cover some basic stuff here. We'll get a lot more in depth as we work through tonight. I'll give you all an agenda. But I always like to show people this. In the United States of America, the federal income tax system is progressive, meaning tax rates increase as your taxable income goes up. A long time ago, I remember I was working someplace and there was a gentleman, his name was Ray. And I remember Ray said to another gentleman I worked with, Dave, I don't want to work this weekend because it's going to put me into a new tax bracket. It's going to put me into a new tax bracket. Some of you in tonight's webinar have probably heard that from folks. Nothing can be further from the truth. In other words, here's what happens. In 2022, let's just pretend you are married filing jointly. You and your spouse earn income, okay? And if you notice on this graph here, you see single, you see married filing jointly. I'm going to cover married filing jointly to start. So let's say between the two of you, you made $20,551. $51. Well, that one additional dollar, $20,551, only that one additional dollar is taxed at 12%, the next tax bracket. While your first $20,550 of taxable income is comfortably left inside of that 10% tax bracket. And so again, it's a progressive tax system as you earn more money, but only those dollars above that figure are taxed at these different tax rates. So if we come down here to the 37%, these are just federal taxes. This doesn't include state taxes or local taxes, just fed. But if you look at it, you know, for a married couple filing jointly, every dollar they perhaps make over $647,000 is taxed at that 37% tax rate, okay? And so progressive tax rate. Also, there's marginal versus effective, okay? So what's the difference between the two? Your marginal tax rate, back to that married couple who made $20,551, because they touched that 12% bracket, that is their marginal tax rate, 12%. However, their effective tax rate is really the blending of all of these different rows here. Their effective tax rate in that instance would still be just 10% at the federal level. By the way, I'm showing you 2022 tax tables, which again, you can see on the screen. I'm bringing up 2013 next to it. You can see in 2013, these numbers have slightly increased. Just look at that 10%, right? Now, if you're married filing jointly, it's your first 22 versus your first 20,550, okay? So let's focus on that highest tax bracket, okay? Looking at this chart, we can see that the marginal tax rate on top earners has varied over time. In 1915, it was 7%. However, during World War II, the highest marginal tax rate jumped all the way up to 94%. It dropped slightly in the years after the war, but it rose again and stayed high through the 50s. Despite being at 50% for most of the 1980s, it dropped and stayed at 28% for 3 years during the late 80s before rebounding all the way back to 39%. You know, that was what it was like up until the tax code changed under Trump, and to where we are today at 37%. You see that 2023, that's that top marginal tax rate. For 2023, the tax rate on highest Americans is again 37%, and it's scheduled to stay that way until 2026. In 2026, unless Congress acts, this is already part of the tax code. It will revert back to 39.6%. Often, when they go to pass changes inside of the tax code, they'll do something and say, we're going to put this into place, but it's going to revert back to where it was after a period of time. We saw that with George W. Bush. We saw that when Trump passed some tax some tax laws under his presidency. And so remember, up here, this is where we sit today. This is 2022. We're all filing our 2022. And again, the highest bracket's at 37, scheduled to go to 39.6 in a few years. Okay. So again, the U.S. federal income tax system is progressive, meaning, as you earn more money, your tax rate gets higher. Overall income taxes cover about half of the revenue that the United States of America made in 2022, right? $2.6 trillion in 22. But here's a few did you know. Did you know that Americans who earned more than $200,000 per year represents 5.8% of returns, and they paid over 65% of that $2.6 trillion that the government collected in revenue. So those Americans earning over $200,000 paid over 65% of all federal income taxes. Americans who earned below $30,000 per year, which represents 36% of all returns filed, paid less than 1% of all federal income taxes. And Americans who earned more than $2 million per year, but below $5 million, paid 7.7% of all federal income taxes. Okay. So today we're going to discuss 8 specific tax issues. First, we're going to recap some key tax rules. Okay. Next, we'll cover Roth conversions. We'll cover healthcare laws and your taxes. We'll talk about distribution actions. We'll talk about tax smart asset allocation. We'll unpack all these topics. We'll talk about gift tax exclusion. We'll talk about tax exempt securities, and we'll talk about the gifting of appreciated assets. The gifting of appreciated assets, not just to charities, but the gifting of appreciated assets really to anybody. So just as a recap, I just want to talk to you all about some tax rules, okay? So for 2023, the standard deduction is $27,700. That's more than doubled what the standard deduction was prior to about 2 years ago. Under Trump's tax plan, they increased the standard deduction. What is the standard deduction, or what is a deduction? Let's just start with that. Let's just pretend you go to work and you make 100 grand. And when you make that 100 grand, you go, hey, look, I get it. It goes through all those tax brackets at the federal level, depending upon what state I live in, the state income tax, so on and so forth. But you go, hey, look, I'm effectively in a 25% once I put that all together. So I made 100 grand. I got to pay $25,000 of income tax if you're effectively in a 25. Well, what happens, what would really happen is, let's just say that person, okay, or that couple that made 100,000, let's just pretend that they were taking a standard deduction versus an itemized deduction. What the government says to you is, they say to you, listen, we know you made 100. On your first $27,700, we're going to act like you didn't make that. We're going to act like you didn't make that. So you would only owe taxes on the delta, $73,300, I think the math works out to. So $73,700 is then what filters through those brackets. But the standard deduction in 2023, $27,700. For those of you who itemize and are married, filing jointly, you only itemize if those itemized deductions that you have are larger than the standard deduction. And if they are, everything I just said still holds true. In other words, hey, you made this, you took your itemized, you're left with your taxable income. Okay, so the state and local tax deduction. So it used to be that you used to be able to deduct your state and local taxes against your federal income taxes owed. One thing that they did is, regardless of how much you pay at the state level, okay, you're only allowed to deduct up to $10,000. It used to be all deductible. That came into place last year in 2022. Child tax credits. The child tax credit is $2,000 per eligible dependent for those with adjusted gross income below $400,000. okay? Mortgage interest. The limits for deducting mortgage interest, okay, stayed the same, with a maximum of $750,000 in principal value. So a lot of folks use their mortgage interest deduction to file itemized deductions. A lot of people, you look at it, hey, paid $45,000 in mortgage payments this year, and 30,000 of it was in interest. 30,000 is larger than the 27.7 standard, and therefore you would take the 30,000, but it is capped. But you can see it has a high threshold. The alternative minimum tax exemption increased in 2023. The exemption for married couples filing jointly increased to $126,000, and the phase out increased to $1,156,300. The alternative minimum tax basically does this. I went through some of these different deductions. Just right now, we're going to dig into a lot more. But what it says is if you make a lot of money, there's this second tax code that kind of exists. And what it does is it just kind of waters down the deductions. Hey, I should have been able to take, this amount of a deduction for this, that, or the other thing. But because your income was so low, they start to water down the amount of deduction you can take. Okay. Under President Biden, what a lot of people don't, or maybe a lot of people do know, but this kind of happened right at the, 12th hour, December, was the Secure Act 2.0. This was President Biden's tax bill that was pushed through. What did the Secure Act 2.0 do? And so for some of you in tonight's webinar, you're probably aware of this first one that I'm about to bring up, and they increased the RMD age from 72 to 73. So if you have already turned 72, you must continue taking your required minimum distributions. But if you are turning 72 this year, or you haven't got to age 72, you don't have to start taking your RMDs until age 73. What in the world is an RMD? I'll answer that because I get the question sometimes. So what an RMD is the government says, hey, when you get to this particular age, any of those retirement accounts that you have, that you are able to put pre-tax dollars into, grow tax deferred, and as you know, they're taxed on the way out, you got to start taking money out of them. Why? Because the government wants their money. You think about it, you had a retirement plan. If you stuck money into the retirement plan, it was tax deductible. Once it went into that retirement plan, it grew tax deferred. You didn't have to pay taxes on it as it grew. And when you take money out, you have to pay taxes. Government said, hey, we gave you all these tax benefits, but at some age, now it's age 73, you got to start taking required minimum distributions. What happens if I don't? So it used to be if you didn't take your required minimum distribution, you would pay a tax penalty of 50% against it. That penalty has now gone down to 25% if you don't take your RMD. And if you fix the mistake promptly, the penalty can drop all the way down to 10%. Also, the amount of money that you're allowed to put inside of retirement accounts has increased. So in 2023, if you have a plan at work, specifically I'm covering here 401ks, 403bs, 457s, these types of things. If you are under the age of 50, you can put $22,500 into your retirement plan. If you are over the age of 50, you can put $30,000 into your retirement plan. I think when I first started in this business, now that I'm saying this out loud, I think the maximum for those under the age of 50 was $12,500, and I think the catch-up was $1,000. So if you're over 50, you get in $13,500. What's also happened with the Secure Act is employers can make Roth contributions to simple and set plans for employees. What does that mean? Simple and set plans are plans that smaller businesses have, okay? And inside of those plans, they were always pre-tax. And along the way, a number of years ago, this thing came out called a Roth 401k. You could stick money into your 401k. It was after tax, but it was considered Roth, meaning it grew tax-free versus tax-deferred. Well, simple and set plans, for whatever reason, when they passed Roth 401ks, simple and set plans were kind of left in the dust. You could only put pre-tax contributions into them. Well, with the Secure Act, the Secure Act 2.0, simple and set plans can now accept Roth contributions. Small businesses, if they establish a retirement plan, generally speaking, when you go to establish a retirement plan, there's setup costs that are involved in it. Setup costs can range anywhere from $500 to $4,000, depending upon what that small employer wants to do. Are they doing, 401k with a pension and that type of thing? And that's what makes the setup different. It used to be that you were able to deduct 50% of that cost as a deduction. Today, it's 100%. And qualified charitable donations, they're now going to be indexed for inflation. So what that means is, in order for you to get a donation credit on your tax return, you could only give out a certain percentage of your earned income in that year. And so let's say you had somebody, they were very wealthy and they had money in the bank, but they retired in 2022. And in 2022, they didn't have any earned income, right? They weren't earning any money. They were maybe just living on the money that they had in their bank, and therefore their taxable income was extremely low, but they were very charitable inclined. And every year they gave $50,000 to the church or whatever charity of your choice. It may be that in that year, because their income was so low, they weren't working, that type of thing, although they had money in the bank, they didn't get a full kind of deduction for that gift to the charity. And so what's happening inside of there is that they're increasing it. Okay. By the way, under 2.0, the Secure Act there's a number of stages that things are happening. And so what I just covered were the changes for 2023, but there's more changes to come, which will go into place in 2024 and in 2025. And so in 2024, what a new feature is inside of retirement accounts. You'll be able to take out $1,000 for emergency without having to pay taxes or penalties. I'm sure there's going to be some more guidelines around this, but right now that's how it reads: $1,000 for family emergencies. Okay. Companies can match student loan payments with retirement contributions. I'm going to get into the stuff that's probably more important to a lot of you on the call tonight, but I will hit some of these things. So what happens is this: today, you own a company, you have some younger folks that are working there. Younger folks are notorious for like, hey, listen, I got my student loan bill. I guess not now. I guess not over the last 3 or 4 years, but historically, hey, I got my student loan. I'm paying $300 a month towards the thing. So I'm not going to save inside the 401k plan. Well, in order for a lot of employees to receive a match into their 401k plan, they have to be contributing money. What can happen now is the employer who employs that person can look at how much that person has paid towards their student loans, and if the employer wants to contribute to their retirement plan, can use those dollars that student or that ex-student, that new employee, is using to pay their loan and make a match towards their 401k. I know that probably sounds complicated. I could explain that better, but it has to do with ADP testing. And if you got 2 employees, one of them isn't contributing, one of them is. The one who is, you could match. The one who isn't, you couldn't match, even if you wanted to. But today, maybe that other employee was making student loan payments, you could match towards it. Something very cool: 529 plans in 2024. So 529 plans are college savings plans for children. What happens at the end of that college savings plan? What can you do with those excess assets? And there used to be other answers to it, but now there's an additional answer, and that can roll over into a Roth IRA, which is pretty fantastic. Roth 401ks and 403bs no longer have RMDs. So it's weird. If you have a Roth IRA, was put in place by Senator Roth out of Delaware, I believe in 1987. And what happened with Roth IRAs is you put money in after tax, you got no tax deduction, but the money grew tax-free. So when you went to go take money out of that Roth IRA, you didn't have to pay taxes on it. That said, they put all these types of ceilings on Roths, and they said, hey, if you make over this dollar amount, you can't put any money into it. But anyways, like I said, a few years ago, 401ks, 403bs, larger employer-sponsored plans, had this thing called Roth 401k, Roth 403b. It didn't matter how much money you made. You could put money into your Roth 401k after tax. It grew tax-free, and you could take the money out tax-free with no income limitations. In other words, nobody was shut out. However, strangely, they said, hey, you got to take RMDs from it. I don't know why, because the RMD didn't matter. The government didn't collect any taxes on it, but they extinguished that, and that's coming in 2024. 2025, employers must enroll employees inside of retirement plans. So today, when a company's sponsoring a retirement plan and they hire an employee, that employee has a choice. They can either enroll or not enroll. What will happen in 2025 is when a new employee joins that business, they will automatically enroll into that employer-sponsored plan, subject to eligibility requirements. You know, sometimes people get a job and you're not eligible to contribute to the plan until a year or 3 months or 6 months or something like that. Once that employee becomes eligible, they will automatically enroll. Can the employee unenroll themselves? Absolutely. Does the employer absolutely have to adopt this? No, there can be exemptions to it. Another thing in 2025. So if you're between the ages of 60 and 63, I don't know why they didn't bring it up to 65, but if you're between the ages of 60 and 63, you'll be able to contribute an additional $10,000 to your employer-sponsored plan. All right, so that was 2.0. And that's a bunch of the changes. There's a whole bunch more changes with it. A lot of it centralizes around retirement accounts, and a lot of it centralizes around, you know, these, when I say retirement accounts, it centralizes around plans that are inside of ERISA, 529 plans, 401ks, SEP, Simples, so on and so forth. And at the end of the day, it's just going to make it so that Americans can stash away more money inside of retirement accounts. As far as Secure Act 2.0, I don't see any issues with it at all. It's making it more advantageous for you all to save inside of retirement accounts. Okay. As part of the 2017 Tax Cuts and Job Act, lawmakers, as I mentioned earlier, scheduled many of their laws to expire. And what this chart does is it shows you the years when this was passed. You can see the chart starts with 2017, and you see these green bars, and this is where they start to expire. So for example, take a look near the bottom of the table where it says double estate tax exemption. The estate tax exemption in 2023 is 12.92 million. But that number will be much lower in 2025, okay, unless Congress does something. Just like I showed you earlier, how the top marginal tax brackets going from 37 to 39.6 or 0.7. So won't estate taxes sunset. Sunset meaning they'll go back to where they were prior. And so what that means is right now that $12.9 million number will get cut in half to about $6.5 million. What in the world does that even mean? Okay, so to check that off there, double estate tax exemption. Today, as I said, it's about 13 million, 12.9. Here's what that means. When you pass away, okay, there's a question. How much will your estate pay in taxes? Well, when you pass away, if you passed away in 2023, and you're married, that money, all of it, say you had $100 million, all of it moves to your spouse. No taxes at all, okay? Your spouse can't live without you. Your spouse passes away 2 weeks later. The estate, as I mentioned, is worth $100 million. In the year of death, an state tax filing must be done. You still file a personal tax return, not you, of course, because you passed away, but your estate's required to file an estate tax return. And when you file an estate tax return, what happens is they look at your net worth, essentially. Look at all of your assets, retirement account, your bank account, your investment accounts, your cars, your real estate, your cufflinks, your anything you got. What's it all worth? Let's just pretend it's worth $100 million, okay? Well, today in the United States of America, what happens is both you and your spouse have essentially a $13 million lifetime exemption. What in the world does that mean? That means this: you passed away. State's worth $100 million. Spouse is still with us. All the assets go to your spouse. No taxes. Spouse can't leave without you. She passes away. When she passes away, because it's only been 2 weeks, the estate's still worth $100 million. And when she passes away, the money goes down to the kids, let's just say. Well, you got 13 million, she got 13 million. Therefore, $26 million passes to the kids without any taxes. Okay, 26 million bucks. However, what that does is that leaves $74 million to be taxed. And that $74 million will first be taxed at an estate tax level. State tax levels roughly 50%. Okay, and so from that $74 million, half of that is now disappearing to the government in estate taxes. Let's say now, with what you're left with, some of those assets are retirement accounts, so on and so forth. Those are still going to be taxed again as the kids access the retirement accounts. Okay, I'm going to show you some strategies to avoid some of this stuff. But what I'm saying here is this went all the way up to 13 million. It's scheduled to go back down to 6.5. We'll see what Congress does. We have until, again, 2026. I can tell you all about the estate tax stuff, but tonight's really just the highlight. What people also need to know is capital gains and long-term capital gains, okay, and long-term gains, long-term gains, capital gains, dividends, these types of things are taxed under their own tax bracket. What in the world do I mean by this? Well, here I showed you this chart down here. I showed you federal tax rates. And so again, we already covered this, right? This is 2023 federal tax rates. That's for earned income. You know, when you hear on the news or you hear like, oh, this Warren Buffett's in a lower tax bracket than his secretary, okay? Well, why might that be? So think about it like this. Say you got two people. Somebody has a salary from a company. Let's say they work at Google as a top software engineer, and they have a W-2 from Google for $1 million. That million, let's say that person's single. That W-2 that they're earning through Google is going to move through this chart down the bottom right, okay, in 2023, and look at those tax rates they're going to pay. And of course, because they have a W-2 of $1 million, a huge portion of their money at the federal level is going to be taxed at 37%. Remember, if you live in a state like Colorado, we have basically a 5% state income tax rate. You'd have 5% to all those brackets. I'm just showing you federal. Okay, now let's pretend you have somebody else and that other person has a big investment account. And from that investment account, they generate dividends, okay? They generate dividends. And those dividends that they generate inside of that investment account is $1 million a year, okay? It's $1 million a year. Well, that $1 million that's generated from dividends is not going to move through this earned income tax bracket, the bottom right one. What it is going to be subject to is it's going to be subject to capital gain tax. Capital gain tax used to be super easy. It used to just be a flat 15% at the federal government level. If you owned an asset, such as a stock, for over a year and a day, you bought it for $1, a year and a day later, you sold it for $2, okay? You would owe taxes on that $1, but at a flat 15%. You own a stock, you bought it for $1, it's worth $2 a year and a day later, you don't sell it, you don't owe any taxes. You only pay taxes when it's realized, But now let's pretend that same stock that you own, you haven't sold it, it paid you a dividend of $1. Let's say it paid you a dividend of $1. That dividend that it paid you was taxable at a flat 15%. That's how it was for ages and ages and ages. Under the Obama administration, what they did was they said, hey, we're going to change the way in which capital gains are taxed, long-term capital gains. So long-term, a year and a day, dividends, these types of things. By the way, if you sold that stock prior to a year and a day, it is earned income. You're back to it being in that graph that's in the bottom right-hand corner. But the way that the new capital gains tax system works is it says on that income, long-term gains, selling a stock a year and a day later, collecting a dividend, so on and so forth, it would be taxed someplace between 0 all the way up to 20%. And how they go to determine what rate that income is taxed at is based upon your earned income, right? Your earned income. So the money that you have coming in. Now, if you thought about it, you go, hey, somebody collects 100% dividend income. They have no earned income. They could be paying as low as 0, which is true. However, if you were collecting that $1 million just in dividends, chances are you have income that is subject to ordinary taxes, such as interest you earn at the bank account, such as interest that you earn inside of, say, money markets and that type of thing, right? So dividend income is taxed at capital gains brackets, but interest income is not. So, most of these folks are going to be paying 15 to 20, but I'm just saying this is how it works, and it's important to understand that. Okay. By the way, you start paying, on those capital gains, and you start paying on those dividends once you, if you were single, once you hit that $44,000 mark. Okay. One way to manage investment-related taxes is to consider looking into tax advantage tools. Excuse me. So what I mean by tax advantage tools are, hey, can I maximize out 401k plans? Can I maximize out IRA plans? Should I be considering different types of perhaps annuities because there's tax shelters related with them? Am I taking advantage of a health savings account? These types of investment accounts, if you will, all offer potential tax advantages such as tax deferred growth, so on and so forth. They can all do things to help mitigate your tax situation, and they should all be considered. There's other tools such as, municipal bonds. And with different municipal bonds, you're not paying state or even federal income taxes. So there's a whole bunch of tools out there to be considering. I'll ask you this. At Triumph Capital, we do a fair amount of pension plans. And so I'll flip the slide here. Most people know this. 401ks. People say, well, listen, Derek, I take full advantage of my 401k plan. As I mentioned earlier, right? You can put in 22.5 if you're under the age of 50. And if you're over the age of 50, you can do with your catch up, you can get in 30 grand. Traditional IRAs, most people know this. Hey, I can put in 6,500 if I'm under the age of 50. If I'm over the age of 50, I can put in, an additional $1,000 for 7,500. When I say we do a fair amount of pension plans, what if I came to you, you owned your own small business, and I said, hey, in a perfect world, how much money would you put inside of your retirement account? And you as a small business owner goes, hey, you know what, in a perfect world, if I could and there was no caps on it, the government said I could put in anything that I'd like, I put in 250 grand. It's above the line, it's great tax deduction, the money's still in my pocket, so on and so forth. Well, what I say to a lot of folks is, you can't. And they go, what do you mean I can't? And I say, well, I don't know if you can. We got to do some testing and everything else, but you can slap pension plans on top of 401k plans. You can also do things like profit sharing. So if you're a business owner out there, you can put in a lot more money than the figures that are on here. Some of you on the webinar tonight may say, hey, listen, Derek, that's great that I can put $7,500 into a traditional IRA, but I don't get a tax deduction for it because I earn too much money. And that is correct. Once you earn a certain amount of money, you cannot put money into a traditional IRA and get a tax deduction. However, you can always put money into a traditional IRA. There is no cap you can make $10 million a year and you can put your $7,500 into your traditional IRA. The question is, will you get the tax deduction for it or not? Well, Derek, why in the world would I put the money in there if I don't get the tax deduction? Because it now goes in there and it grows tax deferred. Yeah, Derek, but you said you were from Massachusetts. They fought a war over that, taxation without representation. If I put the money in there and I don't get a tax deduction, someday I'm forced to take it out because of RMDs, and therefore, because I didn't get a deduction, then I'm going to take it out, I'm going to pay double taxes. And I would say, no, you will not. The money you put in there comes back out to you, no taxes. You will not pay double taxes. We did fight a war over it. Again, highlight leveling a lot of things, but these are all tools that can be used. So what determines tax deduction phase out for these different types of IRAs? Traditional IRAs, your income, the way that you file, and do you have access to a workplace retirement plan? In other words, okay, let me unpack this for you, all right? Let me just explain. So the first thing is this, all right? If you're a single person, okay, and you do, by the way, if you don't have access to a workplace retirement account, you work someplace, they don't offer you a retirement plan at all, okay? You can make $10 million a year. You can put in your 7,500 or your 6,500, depending upon your age, fully tax deductible. What if they offer you a retirement plan at work? Okay, if they offer you a retirement plan at work, here's those income caps. If you earn over $73,000 and you're a single person, okay, you can still put money into a traditional IRA. It's just not tax deductible, okay? If you're married filing jointly, and you have a plan available to you at work, it's $116,000. I'll give you a curveball. Hey, I don't have a plan at work. My wife has a plan at work, okay? Then what happens is they raise that number up to about 218,000. Okay, again, this is just the deductibility of it. Roth IRAs. Roth IRAs, there is income limitations. If you make over a certain dollar amount, you are not allowed to put money into your Roth IRA. I can't tell you how many people I have that come in as clients and they go, Derek, every year I put my 7,500 into my Roth IRA. And I say, how in the world can you do that? You make too much money to put money into your Roth IRA. As a single person, it's 138,000. As a married filing jointly, it's 218. If you make over those numbers, you're not allowed to put money into the Roth. And they say, what do you mean I'm not allowed to put money into the Roth? I have an E-Trade account, and I call up and I ACH the money in. And I say, listen, I'm not saying you're not allowed to do it. You can do it. You go call up, you make over these numbers today, you call your E-Trade, you ACH in the money. They're not going to tell you no. It's no different than I can drive on the road 200 miles per hour. I got a car, it'll go that fast, but I'm not allowed to do it, right? I shouldn't be driving 200. You'll get a letter from the IRS 3 years later, and then it's a real mess. You have to take out excess contributions and pay taxes on different types of earnings, blah, 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 blah. But I see it all of the time. Listen, I bring this up because at different phases in your life, these types of plans come in and out. In other words, maybe you lost your job. Maybe you're in that first stage of retirement where you used to go, hey, IRAs don't apply to me. But you're in that first stage of retirement where maybe you're using some of those savings accounts so you don't have this big taxable income, but maybe you're still doing a little bit of work over here. All of a sudden, these things you're able to do. Also, there's things called backdoor Roth IRAs. We do a ton of them. I won't go into them here, but it enables you to get money into a Roth IRA regardless of your income. Every year, I max out my Roth IRA and I make over the income limitations. I'm not allowed to put money directly into the Roth IRA. I put money into my traditional IRA and then I backdoor convert it. We're going to cover Roth conversions here in a moment, which we'll go into. This isn't backdoor Roths. This is a real Roth conversion. So if we move into Roth conversion, some of you are probably getting a little hot in your seat. Derek, what's a Roth conversion? I keep hearing about it. Well, you keep hearing about it because the first thing with the Roth conversion, if your money's in a Roth IRA, you're not required to take any RMDs. Again, you're not required to take RMDs because there's no taxes coming out when you have a Roth IRA. Okay. What is a Roth conversion? A Roth conversion is when you have a traditional IRA. When I say a traditional IRA, that includes a 401, any pre-tax, so a 401k, 403b, 457, SEP, simple, so on and so forth. I'm just going to refer to it as a traditional IRA. And you decide to convert a portion of that or all of it into a Roth IRA. When you go to convert it, okay, you owe taxes on the conversion. Why? Because you took money out of a traditional IRA. When you do that, you owe taxes. If it converts to a Roth IRA, now it is inside of an account that grows tax-free. You just grow it tax-free. Never have to pay taxes on it again. Okay. And sometimes people say to me, well, Derek, I looked at it, didn't make sense for me. Well, remember, it's all about life stages. It might make sense for you today. It might have not made sense for you 2 years ago. I'll give you a perfect example. The clients, they're working, they're earning money. Again, they get to that first stage of retirement. Maybe they're not earning money anymore, so their income taxes, if you thought about it, are relatively low. They have savings or regular investment accounts that they're accessing. There's ways to access that stuff where you're really not paying any taxes on it. In other words, they're in an extremely low tax bracket sometimes those first few years of retirement, okay? And they're looking at their IRA, it's got $1 million in it, whatever, and they go, geez, if I go to convert this thing, I'm going to pay, 37% plus my state taxes. I'm going to give up half of it to convert it. Well, you think about it, back to those tax tables. Hey, what if we went out there and we converted 90 grand of it at the low 12% level? Oh. Now remember, that might just be like a hole, right? Because all of a sudden you start collecting Social Security 2 years later, or maybe you start getting paid out for the business you sold 2 years later, whatever the case may be. All of a sudden that earned income goes up. So it makes sense. You got to look at this stuff every single year. There's a whole bunch of additional estate strategies to consider when you go to do conversions from traditional pre-tax retirement accounts into Roth conversions. There is a new rule. It's about 2 years old now. Once it's done, once you convert, you can't go back. You used to be able to go back. You used to be able to do a Roth. Go, I made a mistake. I'm going to convert it back. Okay. And the whole thing that I explained earlier with backdoor Roth IRAs, it's not a loophole. Okay, I don't like the word loophole. I feel like all law that's written, it's not a loophole. There's holes, but it is a loophole. It is a hole that may be addressed by Congress prior to 2026, when a lot of things go to sunset. So if you're doing backdoor Roths, I've been doing backdoor Roths for about 12, 13 years personally, they may go away in a few short years. If you're not doing backdoor Roths and you're earning income today, you can do backdoor Roths. It's just a way to get money into Roth IRAs, something you should know. Healthcare laws in your taxes. So let's talk about healthcare laws and how they may affect your taxes, okay? So there are 2 additional taxes that may affect high income taxpayers. Those 2 additional taxes are the additional Medicare tax and the net investment income tax. These are better known to a lot of you as the Obama tax. So let's start with the additional Medicare tax. As of 2013, high wage individuals pay an additional 0.9%, so basically 1%, on wages above a certain threshold. Who's subject to this tax? So I keep saying high income taxpayers, but if you're married and you file taxes jointly, you are subject to a 2.35% tax on your combined wages that exceed $250,000. So on your wages above $250,000, you pay an additional 2.35%. Okay. As compared to the 1.45% tax you pay on the wages below that threshold. Okay. So for those higher income earners, right, above 250, all dollars pay 2.35, but their dollars below that also get taxed at 1.45. If you add those two together, it comes to 3.8. So if this sounds confusing to you, it comes out to 3.8. Okay. And that's why you see 3.8. That's maybe why 3.8 is inside of your head. Okay. If we look at an example, by the way, what if you're single? Okay. If you're single, okay, the tax applies to wages that exceed 125,000. So on all your dollars above 125,000, you pay that 2.3, and then on your dollars below that, you're still paying that, that 4.5. If we look at an example, a single individual in 2023 with wages of 240,000 would owe tax at a rate of 1.45 on their first 200 grand and a rate of 2.35 on the wages above the 200 grand. So on the remaining 40,000, okay? And that's what works its way out to the 3.8 Obamacare tax or Medicare tax on investment income. And so these taxes, if you think about it, it's always a question of how do I reduce these taxes? How do I reduce these? How do I do things to protect myself from the tax man? And that's what we're trying to unpack. And again, this is really high level because you need to get involved in this stuff to really kind of pick away at it. And it's different year to year depending upon your situation and the income that you have coming on. But when it comes to other deductions, and we look at medical deductions, prior to me doing this presentation, I was on the phone with a client of mine who's out in Tennessee, and she's thinking about getting LASIK, and the LASIK that she's getting is going to cost her like $8,000, and she's asking me, is it deductible? Many people believe that their medical expenses are deductible. The way that medical expenses truly work is that it is deductible. What is deductible is what exceeds 7.5% of your income. So if you made $100,000, okay, and you spent the $5,000, that $5,000 only represents 5% of your income, right? I didn't take deductions against it and all that because it does get a little bit complicated. But what the way the tax code reads is that medical expenses are deductible, but only on the dollars that exceed 7.5% of your income, okay? But when we go to medical expenses, there's all these things you can do. The use of HSA, health savings accounts, as a single person, you get 3,600 into a HSA in 2023. If you're married, that number doubles. If you're over the age of 50, there's even a catch up inside of there. Again, pre-tax plans, deductions above the line. Distribution actions. So if you think about it, the way that we go about this is, really every year you got to sit down, you got to look at an inventory of all potential sources of retirement income. Some of you can look at this and say, hey, I'm going to take income from this bucket or that bucket, or I'm going to delay this, or I'm going to delay that. It's very important. By doing so, you can mitigate the taxes that you'll pay. There's all types of strategy around this. There's all types of advanced software that we use, so on and so forth. You want to understand and review the tax treatment of each item. What I mean by the tax treatment of each item is, hey, what happens if I take money out of this account versus that account? What happens if I go and put money into this type of investment versus that type of investment? Consider adjusting your asset allocation. I can't tell you how many clients we have come in and they own municipal bonds inside of a retirement account, or they own an annuity inside of a retirement account. They just own the wrong asset inside of the wrong account. It really has nothing to do with investing. I'm not talking about what is the correct investment for somebody. I'm talking about the tax allocation of that investment being inside of the right accounts. I see a ton of stuff that doesn't make sense. It can really mess you up from your tax situation. You can do so many different things to help mitigate your tax liability. When you're looking at those sources of retirement income, so many folks forget the fact that they have to take RMDs. Again, that's got pushed out to 73, but all of a sudden RMDs come into it. How do RMDs, by the way, on the RMD, I just kept giving you age, but how's it really looked at? It's really kind of simple. What happens is you got to look at all of your pre-tax retirement accounts, what their value was on 12/31 of any particular year. What did all those things add up to? Okay. Based upon what they added up to in your age, there's a table. We have software that does it. It says, hey, here's how much your RMD is going to be. That's 100% taxable income to you. But again, pushing all these things together, there's all these different things you can do to mitigate that tax liability. Tax smart asset allocation. I really talked about this before. It has to do with just holding the right type of investment inside of the right type of account to do what? To mitigate the tax situation or help the tax situation. Gift tax exclusions. I can't tell you how many people are confused about this. Derek, I can make a gift. Derek, I can make a gift. Who's going to pay taxes on it? Let me just unpack this for you very simply. Okay. First of all, in 2023, you can gift $17,000 to as many people as you want. You could literally stand in the middle of the city with your checkbook and write $17,000 gifts to everybody. Derek, do I get a gift? Do I get a deduction for that? Blah, blah. No, you don't get a deduction for that. You might get a deduction if it goes to a charity, which we'll talk about in a second. But you're like, well, then why do people give these gifts of 17,000? Okay. So here's where it comes from. It's just an estate planning technique. It used to be, I gave you a big number earlier. I said 13 million you can die with and not pay estate taxes. And if you're married, 26 million. Again, I then said that's going to go back down to 6.5 million unless Congress does something. But I remember, not when I first got into this business, but in about 2010, that estate tax number was $1 million. Okay, married couple, $2 million. But it was very low, $1 million. By the way, President Bush passed that after 9/11. He's the one who brought it up to 10 million, but it was supposed to revert back in 2011 or 2012 back to $1 million. And Obama was in office. They didn't do anything with it. They didn't do anything. So it was either 2011 or 12. That 1 year, you could die with unlimited amount of money and there was no estate tax. Earlier, I told you I'm from Massachusetts. And so as you can imagine, I'm a Red Sox fan. And up until recently, but basically my whole life, the New York Yankees were always sticking it to the Red Sox. Do you know who passed away in that year where you could die with unlimited amounts of money and there was no estate tax? George Steinbrenner, again, sticking it to those Red Sox. But anyways, what does this $17,000 do? So it's an estate planning, it's really an estate planning technique. So you think about it, you're looking at your estate and you have over the threshold. Let's just say it's $1 million. And I'm working with you. And I say to you, we do estate planning at the office as well, but I say, listen, the kids are going to end up with this money. Today, your estate is worth over $1 million, okay? Why don't we start gifting to the kids $17,000 a year? Okay, so why is that? That gift is just being used to mitigate your estate value, right? If you went and spent the 17,000, which you could certainly do, it would mitigate your estate value. You're just not allowing it to grow as much. Now, look, there are all types of fancy things we can do with that $17,000 gift to the kids. Well, listen, I don't want to give it to the kids today. They're just going to spend it on garbage. Okay, no problem. We gift it to a trust, or we put that trust inside of an islet. There's all these kind of fancy things we can do with it, but that's all that is. Derek, what happens if I make a gift at 20,000? I got to pay taxes on 3, or the person who got it's got to pay taxes on 3? No. On that $3,000 that you did over the limit. So I said you made a gift at 20,000, okay, which was 3,000 over the limit. That $3,000 just eats into your lifetime exemption. Lifetime exemption today is about 13 million. But again, let's just pretend it's a million. So wait a minute, Derek, I make a $20,000 gift. Lifetime exemption is only a million. We go back to 2010 numbers. I get confused, 2020. 2010 numbers. So now I'm only allowed to die with $997,000, right? Because you gifted $3,000 above the 17. It just eats into your lifetime exclusion. Okay, Derek, I kind of get it. Again, this stuff, there's a lot of moving parts here, but it's combining all these things to come up with some solution to help with your planning. We're going to get back to gifting at the end here in a second. Treasury securities, tax exempt municipals, so on and so forth. We're nearing the end. I told you there was 8 points, but when we talk about the types of securities to use, I can tell you this, there's all different types of securities, 529 plans, tax exempt munis, treasury securities, all these different things that are tax exempt or have tax shelters around them. I never will forget there was a trust that was left to these 2 kids, and it was supposed to be set up for college, and it was a few $1,000,000 because it was a trust that had these high tax rates, and they were paying something outrageous in tax rates, but the entire trust was to be used for the kids' education. If they didn't go to school, some qualified higher education, the trust went back to the family and all that. Chances were the kids were going to go to school. We came in, we worked with the trustees, so on and so forth. We put the money into 529s. They went from paying $300,000 a year just in gains, so on and so forth, to zero, literally with the stroke of a pen, to zero. So, and by the way, they had it like this for over a decade. They could have been paying zero for that entire decade. But using the correct securities inside of accounts. I know I keep coming back to it, but just because you're using the correct type of securities, treasuries are just treasury bonds issued by the United States government. They're subject to a whole bunch of risk. We just saw Silicon Valley Bank basically go defunct for holding agencies, treasuries, and MBS, but subject to interest rate risk. The value of these types of securities declines as interest rates go up, so on and so forth. So there's no, even though treasuries are cash equivalents, there's no investment out there that is perfect. There's nothing that mitigates risk totally. But if you're a higher income taxpayer, you have money inside of there today, treasuries, today, municipals, these types of things are paying much higher rates of interest than we saw over the last 20 years. And when you go to calculate out what is your net rate of return, I always laugh when I have somebody and I say, top of the line rate of return. Would you rather have 10% or would you rather have 7%? Of course, everybody says 10%, but it's not always about that 10 or that 7 or whatever the difference is. It's about how much you keep in your pocket. If you achieved the 10% rate of return but had to pay 50% in taxes, you were only left with 5. Yeah, in your account statement it says 10. So what? What if you were able to achieve 6 or 7, but you kept 100% of it? It's a heck of a lot better than the 5. So tax efficiency plays a huge role inside of your overall planning, and it increases those rate of returns when done correctly, if that made sense to you. We talk a little bit about inside of here municipal bonds. So obviously with what's in the news today, hey, are these municipalities and agencies going bankrupt? No, very seldomly do municipals go default. Over the course of 50 years, we've had 114 muni rated municipals issuers go default, basically less than 3%, probably less than 2.5% of all bonds that have been issued. But you look at these muni bonds, and even though they're very close to riskless, they produce tax-free income. And if you're thinking about, yeah, they don't do great of a rate of return, take a look at them again. Interest rates have gone way up. You look at even a money market today is paying 4.5%, and it'll start paying 5% next month. Here's one thing I want to end with: the gifting of appreciated assets. I see people make this mistake all the time. Derek, I give money to the church every year. How much do you give? 10,000 bucks. I say, how do you give it to them? They say, I write a check. I say, that's the worst thing in the world you could do. Why? I get my $10,000 deduction, Derek. I say to them, here's your investment portfolio. You own a stock inside of here that you paid $1,000 for. Today it's worth $10,000. Why don't we just give them the stock? Derek, to the church, they don't take a stock. Pick up the phone, call the church. Church says, we absolutely take stock. Here's our DTC form. What is the DTC form? A DTC form is a form that they give to you, and it says, hey, we have an account with such and such brokerage firm. Here's our account number. Here's our DTC number. It's like a routing number. Mr. and Mrs. Smith, you have bought in this security for $2,000. It is now worth $10,000. We're going to give this stock to the church. You just need to sign this DTC form. It goes right into the church's account in one day. Oh, but Derek, the church is going to have to pay taxes on it because, I only paid $2,000. Now it's 10. No, they won't. They're a tax exempt organization. They don't have to pay taxes on it. Okay. Oh, I don't want to burden them. You're not burdening them. They get stock that comes in all the time. They either have given their broker the discretion to sell those securities to cash when it comes in, or they say, keep it in the security if you deem appropriate. Doesn't matter to them. Okay. What does it do for you? You still got your $10,000 deduction. Okay, Derek, so then who cares if I gift an appreciated asset? Well, remember how you bought the stock for $2,000 and now it's worth 10? If you went to go sell that, you would have to pay taxes on the $8,000, right? To write the check. When you gift an appreciated asset, you get a double whammy. One, you didn't have to pay taxes on your gain. Okay, so that was you don't even realize it, but that you just got that. And then number two, you got your tax deduction for gifting it to the church or the charitable organization. Derek, what if I gift that appreciated asset to my son, my daughter, my whoever, a non-charity? If you gift it to a non-charity, you don't get a deduction because it's not a qualified gift going to a charity. You don't get a deduction. However, what you do get is you gifted them the stock. They take on your cost basis, right? It's like they got it at $2,000, so they have to pay it. I don't know if you want to stick the person you're gifting money to with the tax burden of that, but you should be aware of that. In addition to all of these things that I'm saying, there's all types of planning that comes into place with gifting assets. You can gift assets to your own trust. You can gift assets to charitable remainder and charitable leads trust. These are accounts that we deal with all the time, and it's not just about estate planning. Derek, I don't need to worry about that. Geez, it's 26 million today, and even if it gets cut in half back to 6.5 million, I don't need to worry about it. Okay, maybe you don't need to from an estate planning standpoint, but maybe these types of gifting. If it's a qualified gift, when you gift money to your charitable trust, it's no different than giving it to a charitable trust. We have the Triumph Capital Foundation. It's a 501. It is qualified. Money can be gifted to that. Charitable assets can be gifted to these types of places, and they can help inside of your overall tax situation. And so, listen, why did I leave gifting of appreciated assets to last? The first thing is, we wanted to focus and talk about getting your financial house in order. Of course, this evening we didn't talk about anything with investment. Normally what we do is market updates. We talk about investing, so on and so forth. During tax season, I always give a presentation like this. We do this behind the scenes for our clients. However, we see so many mistakes that are made. We see so many people that just aren't handling this aspect of their planning as they should, and it plays such a huge role in the overall planning. We want to help our clients build financial lives that reflect their values, and looking at this stuff. In addition, your situation changes every single year. Yeah, I get it. Sometimes you might go years and years and the situation's kind of the same, but it can change dramatically from year to year. And the tax um, alpha that can be found year to year should be discovered, should be looked at, should be planned towards. So listen, at the end of the day, when we help our clients, we analyze, needs and goals. We help with the investment process. We set realistic performance expectations. We do everything with software that tracks all this, shows you where you're going, so on and so forth. We try to take every inch we can get. When I say every inch we can get, if we're talking about tax stuff tonight, if we're talking about tax advantaged investing, if we're talking about offsetting, gains with losses and tax harvesting, so on and so forth. These little inches that you get before you know it, they add up to a foot. Some of this stuff isn't picked up in portfolio return, but believe me when I tell you, if you could qualify it as portfolio return, you should be able to eke out equivalent to about another 3% in investment return by being efficient with your taxes. It won't show up in a performance report, but truly, if you back engineer the math, you get between 1 to 3% of return, if you will, by being efficient. And obviously, we monitor portfolios and work with you year after year after year in the planning. If you had this presentation, you can click on this and you can schedule an appointment. So because tonight we're on the web, and I know a lot of you do get the recording and watch this later, so on and so forth. Thank you all for joining. Again, this was just very high level. I don't think this isn't to speak to anyone's situation. This is just kind of to highlight there's a million different things out there you can do when it comes to tax efficiencies and things you should be looking at. And can I take advantage of this, that, or the other thing, whether it be HSA, whether it be backdoor Roth, whether you should be doing a gifting strategy, so on and so forth. These are all things we can help you plan for. Thank you all for joining tonight. I'll leave you all. I'm always a little long-winded. Tonight, not bad, only 13 minutes over the hour. Listen, please join us for future presentations. This tax one maybe is not that interesting to many of you. Many of you like the investment stuff. We have a lot more stuff coming out this year. Some of the investment stuff that I'm putting together for the first quarter, truly interesting through the first quarter of 2023. I think you'll really like it. You'll all be getting an invitation to that in the coming days. Thanks again, and if you need to get a hold of us, contact information is right there. Please download your PowerPoint presentations. You can go to our website. That same link is there. Thanks again, and again, if you have questions, on a webinar, we don't open up for them because there's a lot of people on tonight's webinar, but feel free to schedule or give us a buzz, and we will be more than happy to answer your questions. Thank you again. Have a wonderful evening, and